Hello everyone, welcome to today's US Open live webinar. It is Tuesday, March 21st, and we are 10 minutes before Wall Street opens. This is your host, Nikos Zabouras, Senior Market Specialist at FXCM. The UBS takeover of troubled domestic rival Credit Suisse has dominated the news over the last few days since it was announced on Sunday, as authorities of course continue their efforts to contain the fallout of the recent SVB collapse, the Silicon Valley Bank, and of course focus now shifts to a pivotal policy decision by the US Federal Reserve against this highly uncertain backdrop. And of course the Bank of England follows a day later on Thursday. We will talk about all of that stuff today in another intense week. But before we begin, as always, please read carefully through the disclaimers and the risk warnings, and then we will go ahead. Once again, please read carefully through the disclaimer and the risk warnings. And of course, as you read through the market commentary disclaimer, let me just point out that whatever is discussed on today's webinar and all of those webinars does not constitute investment advice and should not be construed as such. Okay, so let's get the ball rolling as we are have Euro USD on our screens. We already said that the UBS takeover of Credit Suisse is what dominated the markets, and of course other efforts by regulators and central banks around on both sides of the Atlantic to contain any spillover effects and assuage market fears around the health of the financial system. So let's quickly go over through those recent events. So on Sunday, Swiss banking giant UBS agreed to buy its embattled domestic rival Credit Suisse for 3 billion Swiss francs, around 3.2 billion US dollars. Of course, with the blessing of the central bank that pledged 100 billion Swiss francs to support in support of the deal, and of course the Swiss government, which granted a guarantee of 9 billion Swiss francs to reduce any risks for UBS. The agreement has definitely helped markets, has provided some reprieve, and we see improved sentiment today. But of course, it was also put together really fast, and oftentimes the devil is in the details, and we may not have heard everything yet. The takeover did not go well over with everyone in Europe, and what has seemed to draw quite some attention is the fact that the Swiss regulator wrote off around 16 billion of Credit Suisse's 81 debt, additional tier 1, and this has enraged the bond holders. Now, other than that, we saw the Fed, the US Fed, the European Central Bank, and 4 more central banks taking coordinated action to enhance US dollar liquidity and ease strains in global funding. Overall, authorities seem to have taken robust measures to seal the financial system, but especially in Europe, this was a matter of confidence crisis and not so much liquidity concerns. No one seems to, and we saw it from the central bank, we saw it from other officials, that they believe that the European system is well capitalized. And of course, over in the US, the major banks don't seem to be in any trouble, but regional banks are definitely more exposed. So it's clear that the situation is not over yet, and this still keeps market on edge, especially as we have key risk events coming up, which we will discuss mostly on the last segment of our webinar. Now, having said that, let's go and see the technical outlook for EUR/USD. Obviously, technicals are in the background, we would say, since the developments around the financial sector is what moves markets. And let's remind you, we talked about it briefly on Thursday, that the European Central Bank did not blink last week and raised rates by another 50 basis points, although it refrained from offering forward guidance due to the elevated level of uncertainty. But President Lagarde noted that officials have a lot more ground to cover if, of course, their baseline projections hold, which is a big if at this point. She also went on to stress that officials are not waning from their commitment to fight inflation, and their determination should not be doubted. On the other hand, markets price in a more conservative 25 basis points hike by the Fed this week, tomorrow, and expectations around the policy path have eased significantly, the Fed's policy path. Given this differential and as sentiment improves, EUR/USD is upbeat today and steps back into the daily Ichimoku cloud, as you can see on our chart here. You see that it runs the fourth straight profitable day. This brings 1.1930 in the spotlight, but we are still a bit cautious again because the events still unfold, and one needs to be mindful of that. The cloud, after all, has contained it in the recent past. You can see that it has trouble moving above the daily Ichimoku cloud, and fresh pressure could ensue. This could lead to a return below the 200-period EMA, but it looks like this critical region of support here in around 1.045 seems distant at this stage. Again, we're going to have to see what comes out from the Fed tomorrow, and this will probably set the stage for the path of EUR/USD from that point on. Now we'd like to turn your attention to the Australian dollar versus the US dollar. And this is why, and the reason why is because we had the minutes from the Reserve Bank of Australia earlier in the day. Now, AUD/USD comes under pressure, weighed by those dovish minutes. Let me remind you that earlier in the month, policymakers from the Reserve Bank of Australia had delivered another 25 basis points rate increase, but tamed their rhetoric around the next moves. Today's accounts of that decision revealed that officials agreed to reconsider the case for a pause at the upcoming April meeting. Essentially, they're opening the door to holding rates steady at the upcoming meeting, almost a year since the rate hiking cycle started for the RBA. Now, bears are in the driver's seat, but a strong catalyst would be required for further losses below this region here at 0.6563. On the other hand, the Aussie comes from a strong week, and lower expectations around the Fed weigh on the greenback. As such, a recovery effort would not be unreasonable, but daily closes above the broader pivotal 0676, 0679 don't look easy. And as we are already 1 minute into the US session, let's shift our focus to the Nasdaq, the tech-heavy index. Now, the index has been remarkably resilient during the banking crowd, partly held by expectations that these developments will constrain the Fed into a more reserved policy path. So it will all come down to tomorrow's decision and commentary by Chair Powell. And it's hard at this stage to gauge how Wall Street will react to any potential outcome. In any case, National 100 is on track to set new 2023 highs, this point here at 12,900. But given current uncertainty, we are a bit cautious for further strength towards 13,724. Now, there are still concerns over the financial system, and as such, there is risk for renewed pressure. However, a very strong confluence of support emerges at the broader 12,170, 11,850, this region here, and a very strong catalyst would be needed for moving below this area, and even so, the downside seems well protected. Now that's it from the technical analysis, and let's round things off with what we expect. Now we expect UK CPI inflation on Wednesday. Headline CPI had eased to 10.1% in January, to the lowest level since September, whereas core had moderated 5.8% and the lowest since June. Now, of course, that's the least important of what we expect. Again, on Wednesday, as we said, we expect the Fed. Expectations had risen sharply after the recent Powell congressional testimony, but have moderated significantly after the collapse of SVB. CME's Fed Watch tools at this point assigns the highest probability to a 25 basis points hike. The Fed finds itself again pulled in two different directions, as persistent inflation and the tight labor market point to the need for further tightening, where the banking crowd calls for a more conservative approach. It's definitely a tough choice for the Fed. However, we think that this is mostly a confidence crisis, and the Fed may need to respond to that most of anything else. A pause could send the wrong signal, but a hike could also aggravate fears that around the financial system, and Chair Powell will definitely have a fine line to walk at this at his press conference that follows 30 minutes later. Of course, in focus will be the updated staff economic projections and the dot plot. However, it's hard to imagine how officials, given that we're in the eye of the storm, how can actually provide any credible projections there. We're going to have to see. We're going to have a lot to watch and a lot to unpack from the Fed policy decision. And the Bank of England picks up the baton on Thursday. Last time it had increased rates by 50 basis points, but we had two dissenters in favor of a hold, of keeping rates steady, highlighting the divisions among policy makers. Now, in typical for the BOE fashion, communication was quite vague, let's say. The central bank had softened its language, but had not ruled out a pause. The BOE believes the UK banking system is well capitalized and funded and remains safe and sound, according to a recent press release. But given that, it may not feel compelled to hold rates, but on the other hand, we've already seen not great fervor to provide more hikes. So in general, there is high uncertainty there as well, and both for the Fed and the Bank of England, it looks like at this stage we have more questions than answers. In any case, caution is needed as events still unfold, and as these are high-risk events that can spur volatility, and as such, as we said, caution is needed. Now, that's it for us from today. We're going to have the chance to discuss the outcome on Thursday, US Open live webinar at the usual time, 10 minutes before Wall Street opens. That's it for me. Thank you for joining me.